Good day, students. Have you realized that we are halfway through the course? It's lecture number 23. Amazing how time flies. That is what life is all about. Time is something that doesn't stay constant. यहाँ पे मैं एक और चीज़ भी ऐड कर सकता हूँ. So don't stock market prices. Stock market prices don't stay constant as well. They keep changing. So, what we must understand through a previous lecture of an efficient market is that we must try to make the best of our time. Whether it's you listening to me right now, or you making a decision into what investments must be made into, or what is your relative rate of return expectations from your investments. These are the things that we must understand. We must understand that the subject of investment analysis and portfolio management will give you a good insight as far as returns and required rate of returns, expected growth rate, discounted cash flows, efficient market hypothesis, and what does efficient markets say. These are the things that we will be able to understand while we're going through the process of this entire subject. In the previous lectures, we talked about mutual funds. We talked about investing alternatives. We talked about what an efficient market hypothesis says. While we were talking about efficient markets, we talked about what does efficient market mean, which means that stock market prices are able to incorporate in their selves all informations available around the stocks, and investors are able to utilize these informations to the best of their abilities or make extraordinary returns comparative to people around them. That is what we looked at into while we were talking about efficient market hypothesis. I told you something about the efficient market hypothesis. I would also like to tell you about the three different forms of efficient markets, in which we talked about the weak form of efficient market, the semi-strong form of efficient markets, and the strong form of efficient markets. These are the three levels of the market hypothesis, and these are the three levels of markets that we come across in our lives. Generally speaking, we must understand that we really cannot have all forms at one time, but we may have different levels of markets at different times. This shall all depend on how the economy is behaving of the country and how we interpret or incorporate economic health into the market. Now, while we are on the subject of economic health and the barometer being the capital market of the health of the country's economy, we would also like to understand what these levels of efficient markets have in store for the general investor. The above average investor, the highly informed investor, or an investor with little or no knowledge about the stock market, but the keenness to invest in the stock market. Now, efficient market hypothesis has its own proponents, its followers, its critics, but there is certain rationale to these markets, in how informations are used in these markets. Now, in the weakest form, at the lowest level of the market's efficiency, we understand that the weak form strategy will look at two specific market information available. Information that could be used in making investment decisions, core and pure capital market related information is interpreted. While in the semi-strong form of an efficient market, we have information that is little more than just capital market related and market related information that is extra information available publicly. Publicly announced information and information that is available to people in general terms. This, as a subset, also includes information of the weak form of the capital market. This would have a bigger canvas, and we would then take advantage of the subset information available at the weakest form of the efficient market and the semi-strong form of the efficient market. We do understand we have another level of the efficient market hypothesis, which would be the strong form of efficient market hypothesis. This would have a much bigger canvas, a much bigger information flowing into investors, and that will encompass information at the largest, biggest level that you need to screen for your investment decisions. Now, these informations would again, at the strongest form, incorporate as subsets information at the semi-strong form level and information at the weak form level incorporated into this level. Obviously, this is information that is used and misused. Now, the strong form information has the ability to incorporate a lot of information that can be used by investors. These informations can incorporate specialized information, maybe not available to the generalized public, or maybe non-public information. We need to understand whether these informations are going to be reflective of your ability to earn profits. We do know by now that stock market prices tend to reflect all information and incorporate information into their stock prices. The stock prices or the stocks also have the ability to preempt, perceive, guess, or have an intuition to incorporate information earlier to actual information being made available. These are informations that are used for making investment decisions. But efficient market hypothesis must not be the only way to make an investment decision. The efficient market hypothesis would have its plus points and its minus points. What we must try to understand and filter out and screen is the level of information, free, priceless information being available to you at a free of cost basis. Because of the availability of internet, because of the availability of competition of research houses, brokerage houses, and security analysts, information being available to you, all you have to do is get the information. And this is what I talked in one of the previous lectures while we were talking about gathering information. because to gather information and to use it to your advantage is something of paramount importance before you actually make an investment decision. Now, these investment decisions, whether they're based on the efficient market hypothesis or the fundamental analysis or the technical analysis, have to be seen as a generalized concept and not purely dependent on one such focused area. But they do help us. Naturally, if you have an efficient market, information is available to everybody. Therefore, it is not possible for one investor to make extraordinary windfall profits compared to the rest of the people in the market. Now, in the efficient market, one of the components that is required is that we must have a lot of investors who have the confidence in the capital markets. Since it is going to be the market makers, the crowd has to be there, give you the feeling of confidence in the capital markets, and that will also give you the depth and liquidity in the capital market. Market makers, or people or investors who are actually focused on the capital markets, will make you feel comfortable with their presence because they only will be able to understand and make you feel that there is something in the stock market worth investing into while using the efficient market hypothesis. So one of the components, one of the requirements is that you must have a lot of people making efforts into investing in the stock market based on their confidence in the stock market. So these are some of the components that will help you make decisions in efficient markets. Efficient market hypothesis will also let you know whether fundamental analysis is usable, whether technical analysis is useless. So, what we must understand by now is what is going to happen once we decide where this is all going to take us to. Having said that, it is understandable that a large number of rational, profit-maximizing investors will actively participate in the market. And individuals cannot make and affect market prices. It's the information that affects the prices. Also, information I mentioned is free of cost. Yes, there is a cost sometimes that you have to pay if you have subscribed to research, you subscribe to a security analyst briefings, but generally it's priceless. Available to you at a click of a button. Investors react quickly and fully to all new information coming in. We talked about buying and selling on rumors and acting otherwise when actually information comes in. But there are forms in the efficient market hypothesis, and we must understand what extent do the securities market quickly and fully react to all the information. And that is when I talk to you about there being the three forms where you'd have public information, non-public information, and information available to you at the market level. So these three levels of market efficiency, along with the efficient market hypothesis, would be understandable in the market efficiencies. Also, it is the strongest form of all non-public information that makes a lot of difference in investment decisions. So while we were talking about non-public information, then the strongest form of efficient markets, we must understand that this information should not be used. This is non-public information, and this non-public information is used as a form of illegal profits. This form may be termed as insider trading. Unethical behavior is seen here at the strongest form of market efficiency levels, the strong form. Non-public information is used and thereby taken as a means of doing insider trading. Now, when we talk about markets being efficient or inefficient, we do understand that these markets tend to incorporate all information into stock prices. These stock prices have the tendency built in to give you information related to market, non-market, and private information reflected in their stock prices. So while we talk about market efficiencies, we must also talk about the way we look at into these weak form, semi-strong, and strong form of markets. Generally speaking, these help us make investment decisions to our advantage or to our disadvantage. But we must understand that these are things that we will be able to use as proponents of stock market hypothesis, especially the efficient markets. So prices reflect all past price and volume data in the weak form. Technical analysis, which relies on the past history of prices, is of little use or no value in assessing future changes in prices. Also, market adjusts or incorporates this information quickly and fully. This is the weak form we talked about in greater detail in the previous lectures. The evidence is the randomness of stock prices and the way they change. If independent, trends in price changes do not exist. Overreaction, hypothesis, and evidence tells us that people and stock prices react suddenly, quickly to all information. So it's much better to simply buy and hold because there are trading costs, there are brokerage costs, there are commissions that you have to pay every time you make a decision based on information. Remember, it's not just the buying and selling difference, it's also the brokerage costs that add up to your profits being minimized. So, this evidence from the weak form tells us that you will have to pay a price for buying and selling stocks too frequently or too quickly. Now, in the semi-strong form, prices reflect all publicly available information. Also, investors cannot act on new public information after its announcement because everybody has that information and they cannot then expect to have above average risk-adjusted returns. Obviously, this semi-strong form of information also encompasses weak form as a subset. But of course, it is more information to public than the weak form. But you cannot use it because this is all public information. In all, people will be using the same information available to you in this form of efficient market. So we must understand the evidence available in the semi-strong form, the evidence in event studies. I'm referring to empirical analysis of stock price behavior surrounding a particular event. Whatever may have happened and the company as means of maybe excessive earnings, excessive expenditures, so we can examine companies' unique returns sometimes. We can find out the residual error between the security's actual return and that given by the index. We talk about relative strength. We talk about a company's performance in relation to the industry or the sector. And in the semi-strong evidence, this helps us make a decision whether a particular stock is behaving with the crowd, behaving with the sector, or showing an improved performance. So the evidence in the semi-strong, we talked about announcements and newses and initial public offerings and accounting changes and splits. We talked about stock splits and what effect they had, the implications of splits, the implications in price immediately following the announcements. whether there is going to be quick reaction to real change in value in the accounting changes, or only issues purchased at offer price yield abnormal returns. That is the best way to invest. Announcements have little impact. So IPOs, the key to success is IPOs. Now, in the strong form, prices reflect all information, public and private. पहले भी मैं बात कर चुका हूँ insider trading की. But it's important to say it again. No group of investors should be able to earn abnormal returns. The rates of return by using publicly and privately information is unethical. It encompasses weak and semi-strong forms as subsets, but nobody should be allowed to use the strong form of hypothesis of this efficient market to make abnormal extra profits. This should not be allowed because this is insider trading. The evidence is to test performance of groups which have access to non-public information. आपको पता चल जाएगा. You look at the balance sheets. How can you be able to avoid all this? आपको broker से पता चल जाएगा. This XYZ gentleman gave an information that he would be buying such and such shares, and this public information is not available. So corporate insiders have valuable private information, and insider transaction must be publicly reported. ये code of corporate governance का एक हिस्सा है. You must announce if you're an insider. You must announce what you're buying and selling. The evidence that may have consistently earned abnormal returns on their stock transactions, ये पता चल जाता है. Nothing to hide from. It's you turning a blind eye towards what actually is happening. So if you look at the strong versus the semi-strong form, we must understand that the strong form all relative publicly private inside information. In semi-strong form, all relevant public available information, and considerable empirical research supports the semi-strong form. What is the semi-strong form of efficient market? It is all relevant publicly available information. इसमें पता चलता है. यहाँ से, this is, I think, the ideal form. जिसमें you differentiate between the boys and the men using the same type of information in a better way. Through what? Through your ability to look at balance sheets better, to look at financial statements in a better way, and also to use technical analysis to your advantage. So then only you'll be able to have abnormal returns or extraordinary returns. Now, I just mentioned about random walk. And what did the random walk idea tell you? Does not state that security prices move randomly. The random walk idea is such that it does not state that security prices move randomly. Rather, it maintains that the news arrives randomly. Stock market prices do not move randomly. The idea maintains that news arrives randomly. And in accordance with the efficient market hypothesis, security prices rapidly adjust to the random arrival of news. So, in the random walk theory or the idea of random walk, it is not the price that moves randomly. It is the flow of information that is random. And in accordance with the hypothesis, security prices rapidly adjust to the arrival of randomness of news. That is what the idea of random walk is. We talked about efficient market hypothesis. This is and a little bit about the random walk, but what are the consequences of an efficient market? What is the cost that you have to bear as an investor? What is the impact on the market as a whole? What does all these quick price adjustments do in response to the arrival of random information? Random information that makes the reward for analysis low because it's public information. Prices reflect all available information. There seems to be no excitement in doing any security analysis, but price changes are independent of one another and move in a random fashion. We have mentioned that new information is independent and is coming in randomness. So, prices reflect all available information. That is one of the consequences of being an efficient market. Quick price adjustment. Keeping in mind that new information is independent. Keep in mind is information is public. So information makes the reward of analysis low. Why? Because everybody is using the same information. So sometimes this can mar or really not excite security analysts. So consistency of returns in excess of risk is the key. The return should be greater than the risk attached to investments in the capital market. Also, the length of time over which returns are earned, because time is of essence. We must equate our earnings in relationship to time, because time is money and capital market is about time and money both. So we must understand that we must make the most use of time and earn the greatest. So in an economically efficient market, what is there in an economically efficient market? Assets are priced so that investors cannot exploit any discrepancy. In an economically efficient market, the assets are priced such that individuals or investors cannot exploit any discrepancies and earn unusual returns. Of course, transaction costs matter, but economically efficient market will deprive people who think they're very smart from making any abnormal returns on information available to them. So economically efficient markets deter investors in getting unusual returns because assets are priced in such a way. Consistency of returns. Generally speaking, consistency of return in excess of the risk that you're going to take. And like I mentioned, the time factor. Then only can you understand what you're going to take as an advantage of from the efficient market. We are not talking about abnormal returns. We're talking about ethically making use of public information. And that we can do best through semi-strong form of an efficient market. While we're talking about the implications of an efficient market hypothesis, what should investors do if markets are efficient? What extra advantage then can they have if the markets are efficient? Since they're not going to have any excitable information or excitable return since the market is going to be efficient. If you look at the technical analysis aspect of doing an analysis of the stock market, we can find that it is not valuable if the weak form holds. The stock market prices tend to incorporate public information. In a weak form, there's no extra information, so technical analysis will be of perhaps little value. So if you turn to fundamental analysis for intrinsic value of a stock or a market, you'll find that not valuable if semi-strong form holds, because you will experience average results. तो जरा सा आप ध्यान से समझने की कोशिश करें कि जब हम बात करते हैं एनालिसिस की, तो हम दोनों एनालिसिस की बात करते हैं, जिसमें टेक्निकल एनालिसिस भी है और फंडामेंटल एनालिसिस भी है। वीक फॉर्म में हम अज्यूम करते हैं मार्केट एफिशिएंट है, तो वीक फॉर्म में टेक्निकल एनालिसिस की कोई वैल्यू नहीं होगी, और अगर सेमी स्ट्रॉन्ग फॉर्म है तो फिर फंडामेंटल एनालिसिस की वैल्यू नहीं होगी। क्यों? इसलिए कि in a semi-strong form of the efficient market, everybody has the same information. Printed, published information. What good would that be to a security analyst when the information is already public? Because a fundamental analyst, a security analyst, a financial analyst was focusing on what? He was focusing on the future. So that future has arrived. So in a semi-strong form, fundamental analysis would not be as exciting as one would wonder. Professional money managers, less time spent on individual securities matters because time value for money. and passive investing instead of active trading. So passive investing is favored, otherwise must believe in superior insight. You must have something extra, the extra ability to make more than an average investor. We're talking about the semi-strong form of markets. So tasks, if markets internationally efficient, what are they? Maintain correct diversification. The key to success, the key to minimize losses, the key to maximize losses are diversification, be it international or local. But if you're a money manager, if you're looking into international markets, you must maintain correct diversification. Achieve and maintain portfolio risk and keep it at a minimum. Also, look at the tax burden that's going to be there, plus control transaction costs, because each transaction cost means commissions, means brokerage commissions, means transaction costs have to be kept at a minimum because they all add and reduce your profitability. So, less time spent on individual securities is good because you're looking at the market as a whole and you prefer the buy and hold strategy, passive investing. You make a good decision, you stick on with your stocks and wait for the right time for them to become ripe. Or if you're an investor looking at international stocks, you must maintain correct diversification. Look at the taxes involved, offshore or locally, and control transaction costs. These all help. These all will make you feel that this implication of efficient market hypothesis can be controlled, can be looked into, can be managed, and not let it take over your investment decisions. Because these three forms are going to be available in different markets. So we must look at what is the best option that can be looked into while talking about professional money managers or maybe investing internationally. Generally speaking, we have to look at the different market anomalies, the chinks, the wrinkles, the ifs and buts between reality and theories. So, exceptions have to be made that appear to be contrary to market efficiency. A lot of things that you have to account for. Earning announcements that affect stock prices. Adjustments occur before announcements, but significant amounts afterwards. Contrary to efficient markets, because the lag should not exist. You made an investment, the announcement has come, but before that happens, the prices have already adjusted to them, but that does not do well to the efficient market hypothesis because contrary to efficient markets, there is going to be a lag. Stock market prices are going to incorporate the information prior to them actually coming, and there's going to be lag when the information actually comes public. Maybe then, like we talk, investing or buying on rumors, selling on facts, the lag would then be a way of you selling off what you bought earlier and selling it at a profit. Because while we do that, we do it to keep ahead of the general public. We try to do that to have extra returns than the general public. So we must try to understand earnings announcements affect stock prices, and we must also look at the exceptions that appear to be contrary to market efficiency. We did talk about things happening differently at the functional level, and what we've been reading in theories and reading in models and reading in books, not actually happening the way they should be. Because there's a difference between what is seen in the marketplace. Time lag, decision lags, timings, different forms of markets, being weak or semi-strong or strong, these all have their implications. These are anomalies that have to be incorporated. You cannot turn a blind eye to the facts. These things are going to make the difference between excellent profits and average profits. You cannot follow one model blindly, one theory blindly, one hypothesis blindly, and not look at the facts. You must also incorporate what is actually happening there. So, we must understand these anomalies will affect a lot of other things as well. For instance, let us talk about price-earning ratios. One would wonder, what has price-earning ratios got to do with an anomaly in a hypothesis or in a market? But we must look at whether low price-earning ratio stocks tend to outperform high price-earning ratio stocks. This is an anomaly. It shouldn't happen, but it does. Low PE stocks generally have higher risk-adjusted returns. Interesting. But these are anomalies of the market between facts and fallacies. But you do know all price-earning ratio information is public information, because how do you derive a price-earning ratio? Obviously, you have the price of the share on a particular day or a particular week, and you also have the earning per shares on which all this ratio is based on. Since price-earning ratio is based on market price and earning per share, that information is available to the public. So, low PE stocks tend to outperform high PE stocks. So, the question then remains, should portfolios be based on price-earning multiples? Could result in an undiversified portfolio. While we were talking about portfolios, or while we were talking about ratios and other indicators, do you remember we talked not to base on our investment decision on one theory or one ratio? So, should portfolios be based on price-earning multiples? Yes and no. Should they be based on earnings per share? Should they be based on the Gordon's growth model? Should they be based on financial statements, balance sheets, information on cash flows? But you can do it on a number of things. And it'll be a better decision. We're talking about anomalies. How about the size of capitals, the capitalization? Does size matter? Does it have an effect on the efficiency? So, I'd like to add that there is a tendency for smaller capitalized firms to have higher risk-adjusted returns than larger firms, larger capitalized firms. We cannot ignore small capitalized companies. Cannot ignore mid-sized capitalized companies. They tend to have higher returns, higher risk-adjusted returns than larger firms. So you may just get more money out of smaller capitalized companies. How about the January effect? Why do we have a January effect? Okay, I'll refer it to the July effect. Okay, January effect would be what? Once you have a calendar year closing or a financial year closing, the month next to that would be called that effect. So you could have a July effect or a January effect if the closures are in December, and July if the financial close in June. Then again, there is a tendency for small firm stocks returns to be higher in January. Why? Because that's when the bag is let out by the cap. The information flow is there in the month after the financial close. In a study, it was found that 30% size premium, half of the effect occurs in January. So which means there's more volatility, there's more excitement in the month following a financial year's close. That is what the January effect is. Or we talked about small-sized companies. So it does matter. Size sometimes does matter as far as capital markets are concerned. Small capitalized companies tend to be more volatile. Small capitalized companies have the tendency to outperform large capitalized companies. And we've already discussed that you'll have more activity in January than other months. Months when calendar year closes, months when you have quarterly earnings. I have noticed through experience that you have cyclical information flows and stocks tend to react then. We also look at ranking systems. There are companies like XYZ company or Value Line company or whatever, ABC company, who rank these markets. So advisory service that ranks thousands of stocks from 1 to 5, with 1 being the best and 5 being the worst. So you have rankings done by advisory companies that will then confuse the efficient market hypothesis. This is another anomaly. Probable price performance in the next 12 months are going to be the same because they've decided what is a company going to be rated as, 1 for the best and 5 for the worst. In a 13-year study, Group 1 stocks had annualized returns of over 19%. The best stocks had a 19%, which is phenomenal. Best investment, performance over was given, and even transaction costs were offset by the returns. Or sometimes transaction costs may offset all the profits that you've done, because sometimes you really get carried away doing all the active strategy transaction and let the broker get all the profits through the commissions. Sometimes these ranking systems create a bias. Sometimes notice that these ranking systems tend to confuse an investor's mind and actually leads investors to make decisions which might not be very healthy. But on the other hand, since we were talking about investor behaviors, and we'll talk about that in just a while or maybe in the next lecture as well, but you tend to get better results because, remember, there has been a certain value of analysis done on all these stocks. And on the basis of several profitability ratios, on the basis of several liquidity ratios, and the basis of several business sales ratios, you tend to grade a number of companies which would have the best chances of outperforming the market. Whether they are blue chip stocks or growth stocks or value stocks, it becomes irrelevant because we're looking at their ability to outperform, the ability to give the best annualized results. So, I remember when we were talking about market efficiencies, we were talking about trying to get extraordinary abnormal returns or getting very average returns or maybe getting no returns at all, depending on how we use the hypothesis. So, while I conclude about efficiency, about the hypothesis, about the market, the support for market efficiency is persuasive. There is a great deal of talk of having an efficient market. There are a lot of support available because there is much research available using different models, because many anomalies are there that cannot be explained satisfactorily. Also, markets are very efficient, but not totally. So, for an investor to outperform the market, fundamental analysis beyond the norm must be done. So, what does it all boil down to? क्या इतनी देर से जो हम efficient market hypothesis की बात कर रहे हैं, इतनी देर से random walk theory की बात कर रहे हैं, पिछले लेक्चर में अभी किया है, अब भी इसमें क्या है? What is all this about? Why must we have efficient markets? Why must we have fundamental analysis? Why must we have technical analysis? Why must we have all these things? क्या ज़रूरत है हमें? Because we must try to behave in a professional way, and while doing that, try to extract the maximum profits through our investments of money, through investments of time, so that we are able to make a respectable living without getting into unethical insider trading, which would then be related to the strongest form of the efficient market hypothesis. The strongest form of the efficient market hypothesis has its own downside, while the weakest form of efficient market hypothesis level has its own shortcomings. So if we look at the middle line, we look at the semi-strong form of efficient market, the level that would be the most appropriate. Not too much information and not too little information. Information that is just related to the market, or information that only available at the corporate level, at the insiders level. So to compromise, I believe the semi-strong form of a market would be a very good form of a market for one to be comfortable with. So while we were talking about random walk ideas, we talked, it's the information flow that comes in randomly. It is not the price of a stock that moves randomly. Stock market prices tend to move very systematically. Stock market prices tend to move prior to information coming in. But since all information is coming in randomly at different times, at different levels, with different levels of seriousness, it doesn't mean that the stock market also behaves randomly. No, it does not. It works in a very systematic way. It is the information flow that is random that has to be screened. It is to be found out which form or which level of an efficient market is the best for an investor. Too much knowledge could be harmful. Too little knowledge could be harmful again. But if it's a semi-strong, which I am suggesting, would have its own negativities, because that is the form which is available to everybody. All information at the semi-strong level would be available to everybody. So, if markets are operational efficiently, if we think that markets are efficient, we must understand that there will be some investors with the skill to detect a divergence. An effort should be made to understand that some investors will have the skill to detect a divergence between price and semi-strong value, which would earn profits. This controversy about the degree of market efficiency will remain. It still is. Maybe it will take some time to settle down, but it excludes the majority of investors from making extraordinary profits. And please do not forget, these anomalies themselves offer extra opportunities. It is the anomaly that will give you a benefit. So you have a downside to anomalies, but they offer you opportunities. This is what we were talking about, random walk ideas and efficient markets. Next time when we get into the class again, we'll talk about behavioral finance as well. We'll talk about the theoretical, empirical, and the behavioral impact on finance. Thank you very much.